Let me take you back to 1874, to a small boarding house in San Francisco, where a man named James Flood was counting his money by candlelight. Just 12 years earlier, Flood had been a bartender serving whiskey to silver miners who would stumble in from the Comstock lode, their pockets heavy with coins and their tongues loose with gossip about which mining stocks were about to explode. Flood listened carefully, invested everything he had, and by the time we find him in that boarding house, he was worth over $30 million. But here's what made Flood different from every other speculator who got rich and then got destroyed. He didn't just chase the next big strike. He bought income-producing assets, properties that paid him rent, businesses that sent him monthly checks. While other mining millionaires went broke chasing the next bonanza, Flood built what he called his forever money, streams of income that arrived whether he worked or not, whether the markets crashed or not, whether he was alive or not. By the end of this video, you'll understand the exact mechanism that Flood discovered 150 years ago. The same mechanism that modern Wall Street has repackaged and sold back to us. The same mechanism that can literally pay your rent while you sleep. I'm going to show you 5 specific monthly dividend stocks that create this forever money, and I'm going to show you exactly how much you need to invest in each one to cover a $1,500 monthly rent payment, a $2,000 payment, or even a $3,000 payment. And the math is going to surprise you because it's not nearly as impossible as you've been led to believe. But first, we need to understand why Flood's approach worked when everyone else around him was going bankrupt. My name is Tom, and I spend way too much time thinking about money and psychology. If you're someone who's tired of watching your entire paycheck disappear into bills and rent with nothing left over, if you're someone who wants to build real wealth without day trading or crypto gambling or any of that nonsense, then subscribe and like this video. It genuinely helps more than you think. Now, here's where the story of James Flood gets really interesting. By 1876, Flood and his partners controlled the biggest silver mine in American history, the Consolidated Virginia, which was producing over $1 million a month in pure profit. Most people in his position would have reinvested everything back into mining, trying to squeeze out every last ounce of silver. But Flood had been watching the other mining millionaires, men like William Ralston, who built the Palace Hotel and the Bank of California, men who seemed invincible right up until the moment they weren't. Ralston's story is worth telling because it contains the exact same pattern we're going to see in modern investing. In 1875, just 1 year before Flood's greatest success, William Ralston was the most powerful banker in the American West. He controlled millions in deposits, he had financed half the buildings in San Francisco, and he was leveraged to the absolute hilt. When rumors started circulating that some of his investments had gone bad, there was a run on his bank. In a single day, depositors withdrew over $1.4 million, which doesn't sound like much until you realize that's equivalent to about $40 million today. Ralston couldn't cover it. The bank failed. And the next morning, William Ralston's body was found floating in the San Francisco Bay. Whether it was suicide or a heart attack from the stress, nobody knows for certain. Flood watched all of this happen. He watched a man who was worth more than him, who was smarter than him, who had better connections than him, lose everything in 72 hours. And Flood learned something that most investors never learn until it's too late. The goal isn't maximum returns. The goal is income you can't lose. The goal is checks that arrive whether the market is up or down. The goal is what Flood called sleeping money, assets that work while you rest. Now, you might be thinking, okay, Tom, that's a nice history lesson, but what does a dead silver baron have to do with my rent payment in 2025? Everything. Because the same principle Flood discovered, the principle of prioritizing income over appreciation, the principle of building cash flow rather than just building paper wealth, that principle is exactly what separates people who achieve financial freedom from people who stay trapped on the treadmill forever. Here's the thing about rent. It's not optional. It arrives every single month, whether you had a good month or a bad month, whether your stocks went up or down, whether you got a bonus or got laid off. Rent is relentless. And the traditional financial advice, which tells you to save for retirement and not touch your investments until you're 65, completely ignores the fact that you need to survive the next 40 years first. You can't just grit your teeth and wait for compound interest to kick in when you're stressed every single month about making rent. But now you might think, sure, dividend stocks sound nice, but the yields are so low that you'd need millions of dollars invested to generate any meaningful income. And 5 years ago, you would have been mostly right. The average dividend yield on the S&P 500 has been hovering around 1.3% for the past decade. At that yield, you'd need nearly $3 million invested just to generate $40,000 a year in dividends. That's obviously out of reach for most people. This is where it gets really interesting, because there's a category of investments specifically designed to throw off massive amounts of monthly income. They're called real estate investment trusts, or REITs, and business development companies, or BDCs, and closed-end funds. And they're structured in a way that forces them to pay out most of their profits directly to shareholders. We're talking about yields of 8, 9, 10, sometimes even 12%. At a 10% yield, you only need $360,000 to generate $3,000 a month, not $3 million. Now you're asking yourself, if these investments pay such high yields, why doesn't everyone just buy them? And that's an excellent question with a complicated answer that I'm going to break down for you. But first, let me show you the 5 specific monthly dividend stocks I've researched, ranked from 5th to 1st, with my top pick being the one that can help you reach your rent payment goal in roughly half the time of the others. Let me start with number 5 on my list. And I want to be very clear about something. Every stock I'm about to discuss has risks. Some of them have significant risks. I'm not a financial advisor, and you need to do your own research before buying anything. But what I can tell you is that these 5 companies have track records of paying consistent monthly dividends through good times and bad. And that consistency is what we're looking for when we're trying to replace our rent payment. Number 5 is AG&C Investment Corp. Ticker symbol AG&C. This is a mortgage REIT, which means it invests in mortgage-backed securities, those bundles of home loans that became famous during the 2008 financial crisis. Now, before you run away screaming, let me explain why AG&C is different from the toxic garbage that blew up the economy. AG&C primarily invests in agency mortgage-backed securities, which means they're guaranteed by the federal government through Fannie Mae and Freddie Mac. If homeowners default, the government eats the loss, not AG&C. This dramatically reduces the risk of catastrophic losses. As of my research, AG&C is paying an annual dividend yield of around 14.5%, distributed monthly. Let me break down what that means in real dollars. If you want to generate $1,500 per month from AG&C, you'd need roughly $124,000 invested. For $2,000 a month, you'd need about $165,000. And for $3,000 a month, the full rent coverage goal, you'd need approximately $248,000. Now those are big numbers, but here's where the psychology of investing becomes crucial. Most people look at $248,000 and think, well, that's impossible. I'll never have that much. But they're making a fundamental error. They're thinking in terms of lump sums instead of thinking in terms of monthly contributions over time. Let me show you what happens when you flip that mental model. If you invest $500 per month into AG&C and reinvest all your dividends, assuming the dividend stays roughly constant, which is not guaranteed but has been relatively stable for the past 5 years, you would reach $248,000 in approximately 15 years. That sounds like a long time until you realize that in 15 years, you'd be getting $3,000 deposited into your account every single month for the rest of your life. You do 15 years of work, and then you're free. Your rent is paid forever. But here's the catch with AG&C, and this is something you absolutely need to understand. Mortgage REITs are sensitive to interest rates. When rates rise quickly, like they did in 2022 and 2023, the value of the bonds AG&C holds drops, which can force them to cut their dividend. AG&C has cut its dividend multiple times over the past decade, It's never eliminated the dividend entirely, but it has reduced it. So you need to monitor this position and be prepared for the monthly payment to fluctuate. Number 4 on my list is Main Street Capital, ticker symbol MANN. This is a business development company, which is essentially a publicly traded private equity firm that focuses on lending to and investing in middle market companies. Think of businesses with revenues between $10 million and $150 million. Companies too big for bank loans, but too small for Wall Street. Main Street provides them with capital and collects interest payments and equity stakes in return. Main Street has an annual yield of around 6.8%, which is lower than AGNC, but comes with significantly more stability. Main Street has never cut its regular monthly dividend since it went public in 2007. Let me repeat that. Through the 2008 financial crisis, through COVID, through every market panic of the past 17 years, Main Street kept paying and actually increased its dividend multiple times. That kind of consistency is extremely rare. At the current yield, generating $1,500 per month from Main Street would require approximately $265,000 invested. For $2,000 a month, about $353,000, and for $3,000 a month, roughly $530,000. I know those numbers are higher than AGNC, and that's the trade-off. Lower yield usually means lower risk and more consistency. But here's what I want you to think about. Would you rather have a 14% yield that might get cut in half during a crisis, or a 7% yield that keeps coming no matter what? There's no wrong answer. It depends on your personal risk tolerance and your timeline. The math on Main Street with $500 per month invested and dividends reinvested shows you reaching $530,000 in about 22 years. That's longer than AGNC, but you're taking on much less risk of the dividend being reduced or eliminated. Number 3 is Realty Income Corporation, ticker symbol O. This is probably the most famous monthly dividend stock in existence, and for good reason. Realty Income calls itself the monthly dividend company, and they've actually trademarked that phrase. They own over 13,000 properties across the United States and Europe, primarily retail properties leased to stable tenants like Walgreens, Dollar General, 7-Eleven, and FedEx. The yield on Realty Income currently sits around 5.6%, which is lower than our previous 2 picks. But Realty Income has increased its dividend for more than 25 consecutive years and has paid over 600 consecutive monthly dividends without interruption. This is a company that has survived the dot-com crash, the 2008 financial crisis, COVID, and every other economic scare of the past 3 decades without missing a payment. To generate $1,500 per month from Realty Income, you'd need about $321,000 invested. For $2,000, roughly $428,000, and for $3,000, approximately $643,000. Now you're probably thinking, Tom, you keep showing me these stocks that require $500,000 or more to cover my rent. That's completely unrealistic. I hear you, and that's why my top 2 picks are specifically chosen, because they can get you to your goal much faster. But I want you to have the full spectrum of options, from higher risk, higher yield, to lower risk, lower yield, because your personal situation is going to determine which approach makes sense for you. Before I reveal number 2 and number 1, let me take a moment to explain something about portfolio construction that most YouTube finance videos completely ignore. The goal isn't to find the single best dividend stock and put all your money into it. That's concentration risk. And it's exactly what destroyed those silver millionaires in Flood's day who put everything into a single mine. The goal is to build a diversified portfolio of income-producing assets, so that if one of them cuts its dividend or goes bankrupt, you're not devastated. Think about it like a restaurant that James Flood might have invested in. Imagine you own a restaurant with 30 menu items, and 7 of them generate 80% of your revenue. You feel successful because revenue is high and customers keep coming back for those 7 popular dishes. But then, food trends change. Maybe people decide gluten is evil, or red meat causes cancer, or whatever the panic of the decade is. Those 7 items go out of style. Suddenly, 80% of your revenue disappears, but you still have rent, staff, supplies, and costs for all 30 items. You're not just less profitable, you're bankrupt. The same principle applies to dividend stocks. If you put all your money into AGNC because the yield is highest, and then interest rates spike and they cut their dividend by 50%, your income just got cut in half. But if you spread your money across 5 different dividend stocks in different sectors, a cut to one of them only reduces your total income by maybe 10 or 15%. You can absorb that. You can adapt. You don't lose everything. This is the principle that James Flood understood instinctively 150 years ago. Don't concentrate. Diversify your income streams. Make it so that no single failure can destroy you. Number 2 on my list is EPR properties, ticker symbol EPR. This is a specialty REIT that focuses on experiential properties, things like movie theaters, ski resorts, water parks, top golf locations, and private schools. The thesis behind EPR is that as our economy becomes more digital and more virtual, people will increasingly pay premium prices for real-world experiences. You can stream movies at home, but you can't replicate the experience of a giant IMAX screen with surround sound. You can play virtual golf, but it's not the same as hitting real balls at a Topgolf. EPR currently yields around 7.8% monthly, which puts it right in the sweet spot between the higher risk mortgage REITs and the lower risk traditional REITs like Realty Income. To generate $1,500 per month, you'd need approximately $231,000 invested. For $2,000, about $308,000. And for $3,000, roughly $462,000. Here's what I like about EPR. During COVID, when movie theaters and experiential venues were completely shut down, EPR suspended its dividend for several months. That sounds bad until you realize what happened next. They brought the dividend back, and within 2 years, they had restored it to nearly the pre-COVID level. They also restructured their lease agreements to be more resilient to future disruptions. A company that survives a complete shutdown of its entire business model and comes out stronger is a company I want to own. The math on EPR with $500 monthly invested and dividends reinvested shows you reaching $462,000 in approximately 17 years. That's faster than Main Street or Realty Income, with a yield that's more sustainable than AGNC. And now, number 1, the stock that can get you to your rent payment goal in roughly half the time of the others. This is Prospect Capital Corporation, ticker symbol PSEC. Look, I need to be very upfront with you about this one. Prospect Capital is not without controversy. It's a business development company like Main Street, but it has a more aggressive investment strategy and has faced criticism from short sellers and analysts over the years. The stock price has been volatile, and there are legitimate concerns about the sustainability of the dividend at current levels. I'm telling you this because I want you to go into this with your eyes wide open. That said, Prospect Capital currently yields around 11.2% monthly, which is one of the highest sustainable monthly yields available in the market. And unlike some high-yield traps that cut their dividends immediately after you buy them, Prospect has maintained its current monthly dividend level for over a decade. Not without bumps, not without scares, but consistently enough that it belongs on this list. To generate $1,500 per month from Prospect, you'd need about $161,000 invested. For $2,000, roughly $214,000. And for $3,000, approximately $321,000. The $500 monthly investment with dividend reinvestment math shows you reaching $321,000 in roughly 12 years. That's significantly faster than any other stock on this list. 12 years of consistent investing, and then your rent is paid forever. Now, you might be thinking, Tom, if Prospect is so great, why is it number 1 instead of the only stock you recommend? And the answer goes back to diversification. Prospect is higher risk. The yield is high, partially because the market is pricing in some probability that the dividend gets cut. If you put all your eggs in the Prospect basket and they cut the dividend by 30%, you're in trouble. The smart move is to combine these stocks into a portfolio that balances yield with stability. Let me show you what that might look like. Imagine you allocate your monthly $500 investment like this. $100 goes to AGNC for the high yield and monthly income. $150 goes to Main Street for stability and growth. $100 goes to realty income for blue chip reliability. $75 goes to EPR for experiential exposure. And $75 goes to prospect for the yield boost. This blended portfolio would have an effective yield of roughly 8.2%, which is lower than prospect alone, but higher than realty income or Main Street. To generate $3,000 per month from this portfolio, you'd need about $439,000. At $500 per month with dividend reinvestment, you'd reach this goal in approximately 16 years. But here's what you gain with this diversified approach. If any single company cuts its dividend, your total income only drops by maybe 10 to 15%, depending on which one it is. You can absorb that hit. You can adjust. You're not starting over from zero. This is where the psychology of investing becomes absolutely critical. And it's something that most financial videos completely ignore. The biggest obstacle to building wealth isn't finding the right stocks. It's finding the discipline to keep investing month after month, year after year, especially when the market is crashing and every instinct in your body is screaming to sell. Let me tell you what's going to happen on your journey to financial freedom, because I've seen this pattern play out hundreds of times. In year one, you're excited. You're putting in your $500 a month, you're watching your dividends trickle in, you're calculating how long until you reach your goal. The monthly payments are small, maybe $50 or $60, but they're real money showing up in your account, and it feels amazing. In year two, reality starts to set in. The monthly payments have grown to maybe $120, which is nice, but still nowhere near covering rent. You start thinking about how many years you have left. 15 years feels like an eternity. You start wondering if there's a faster way, a shortcut, a way to accelerate this process. In year three, something bad happens. Maybe the market crashes 20%. Maybe one of your dividend stocks cuts its payment. Maybe you lose your job and have to reduce your contributions. This is the make or break moment. Most people quit here. They sell their positions at a loss, they convince themselves the whole thing was stupid, and they go back to living paycheck to paycheck. But if you push through year three, something magical happens. Your portfolio has grown large enough that the dividend payments are starting to become meaningful. Maybe you're getting $250 or $300 a month. That covers a utility bill. That covers groceries for a week. That's real money, making a real difference in your life. And from there, the compounding accelerates. Year four, you might be getting $400 a month. Year five, $600. Year six, $800. Each year, the growth gets faster because you're reinvesting larger and larger dividend payments. By year 10, you might be getting $1,500 a month, which covers a significant portion of your rent. By year 15, you're at $3,000 and you're free. But the only way to get there is to survive year three. And the only way to survive year three is to build a diversified portfolio that can absorb shocks without collapsing, to keep contributing even when it feels pointless, and to remember that the goal isn't maximum returns, but sustainable income. Now let me address something that's probably been nagging at you this whole video. What about taxes? The IRS isn't just going to let you collect $3,000 a month in dividend income without taking their cut, right? You're absolutely right, and this is where a little bit of strategy can save you enormous amounts of money over time. The dividends from most of these stocks are classified as ordinary income, which means they're taxed at your marginal income tax rate rather than the lower qualified dividend rate. For someone in the 24% federal bracket plus state taxes, you might lose 30% or more of your dividend income to taxes. But there are ways to minimize this impact. The most powerful is to hold these dividend stocks inside a Roth IRA. With a Roth, you contribute after-tax money, but all the growth and all the withdrawals are completely tax-free. That $3,000 monthly in dividends, if it's coming from a Roth, you keep every penny. The current contribution limit for Roth IRAs is $7,000 per year for most people, or $8,000 if you're over 50. At $500 a month, you'd be contributing $6,000 per year, which fits within the Roth limit. You could stuff all of this into a Roth and never pay a dime of tax on the dividends. Now, there are income limits for Roth contributions. If you're single, making more than $161,000, or married, making more than $240,000, you can't contribute directly to a Roth. But there's a backdoor strategy involving traditional IRA, contributions, and conversions that gets around this limit. It's slightly complicated, and you should probably talk to a tax professional, but it's completely legal and widely used. The point is, don't just buy these dividend stocks in a regular brokerage account and pay taxes every year on the income. Be strategic. Use tax-advantaged accounts. The difference over 15 or 20 years could literally be hundreds of thousands of dollars. Let me give you one more piece of the puzzle before we wrap up. And this is something that took me years to understand. The goal of dividend investing isn't to maximize your total return. It's to maximize your peace of mind. Here's what I mean. The S&P 500 has historically returned about 10% per year on average. A diversified dividend portfolio like the one I described might return 7 or 8% per year when you include both dividends and price appreciation. By pure numbers, you'd have more money after 20 years if you just bought an S&P 500 index fund. But here's what the pure numbers don't capture. An S&P 500 index fund doesn't pay you every month. When the market crashes 50%, like it did in 2008, you don't have income coming in to pay your bills. You're just watching your net worth evaporate and hoping it recovers before you need the money. With dividend stocks, the income keeps coming even when prices are crashing. In fact, during the 2008 financial crisis, Main Street Capital's stock price dropped over 60%, but the dividend kept getting paid every single month. If you held through the crash, you kept getting your income. And if you were smart enough to reinvest those dividends into cheap shares, you made a fortune when the market recovered. This is the psychological advantage of dividend investing that nobody talks about. When you have income arriving every month, regardless of what the market is doing, you can stay calm during panics. You can hold when everyone else is selling. You can buy when everyone else is terrified. The monthly payments give you the emotional stability to make good long-term decisions. And that emotional stability is worth more than a few percentage points of return. So let's bring this all together. Here's your action step for today. The one thing I want you to do before you close this video. Open your brokerage account or open a new one if you don't have one. Look for any of these 5 tickers: AGNC, MAIN, O, EPR, or PSEC. Don't buy anything yet. First, pull up the dividend history for each one. Look at how consistent their payments have been over the past 5 years, 10 years, even longer if available. Look for the cuts, the increases, the gaps, if there are any. Then, run the math for your specific situation. How much is your rent? What yield would you be comfortable with? How many years are you willing to commit? Calculate exactly how much you'd need to invest each month to reach your goal. Write that number down. Put it somewhere you'll see it every day. That number is your freedom number. That's how much you need to save each month to eventually never worry about rent again. And then, when you're ready, when you've done your research and you understand the risks, start buying. Start small if you need to. $100 a month is better than zero. The important thing is to start, because every month you delay is a month of dividends you'll never get back. James Flood started as a bartender serving whiskey to miners. He ended as one of the richest men in America, not because he found the perfect investment, but because he understood the difference between speculation and income. He understood that the goal isn't to get rich quick, but to get rich for certain. He understood that money that arrives every month, month after month, year after year, is worth more than any lottery ticket or hot stock tip. You have access to tools Flood couldn't have dreamed of. You can buy fractional shares of income-producing businesses for less than the cost of a cup of coffee. You can reinvest dividends automatically without lifting a finger. You can diversify across sectors and geographies with a few taps on your phone. The only thing standing between you and financial freedom